Price volatility is a complex concept, but it's one that every single trader needs to learn because it gets thrown around a lot. So let me explain. Volatility realistically just means simply how much one market is shifting relative to normal. You might come up with different answers as to where the market is, but volatility is measured against a standard of the market. So if something is more volatile than the market typically is, then we say it's volatile, and if something is less volatile, then it's stable. So an example of volatility would be Aussie dollar pairs are most active when Aussie markets are open. Even though the Aussie is active and tradable 24/7, it's most volatile during the hours when a Sydney market is open, and during London business hours, the Aussie and its related pairs will be less volatile. This movement reflects volatility. If a position goes through remarkable changes in value, we call it a volatile position. In contrast, low volatility indicates a position stability. In the event that a trader buys an asset, they anticipate one way for a rise in value to take place as a result of the transaction. A seller, on the other hand, expects the asset that they sell to decrease in value during the transaction. The unpredictability of an asset's value produces a higher degree of risk, while setting its worth generally increases its potential for greater profits. The less risk an asset has, the more apt it is to trade only for a restricted profit margin. Although highly volatile trades can be extremely lucrative trade decision, they also possess plenty of risks. At the same time, high volatility can be employed in your favor if you leave yourself open to risk. What causes volatility in Forex trading? Economic events can also trigger volatility in the Forex market. For example, if a country's inflation rate rises unexpectedly, this could lead to a sell-off in its currency. Natural disasters can also cause currencies to fluctuate wildly. If a hurricane hits a country that heavily depends on tourism, for instance, this could lead to a sharp decline in its currency's value. How to determine asset volatility? In trading, volatility is measured using trends and swings to analyze the severity of market price fluctuation. And certain indicators include moving averages, Bollinger Bands, and average true range. Each of these indicators can be used slightly differently to measure the volatility of an asset, and more importantly, interpret this data in a different format. In conclusion, volatility is a measure of how much the price of an asset fluctuates. It arises when there is uncertainty about the future, and traders are buying and selling assets in an attempt to make a profit. Volatility can be caused by political or economic events, as well as natural disasters. When volatility is high, it can lead to market crashes.